So let's get October and Q4 started. Live from New York City this morning. Good morning, good morning. Equities rallying. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, kicking off Q4.
Look, we've done a lot of damage, obviously, in the third quarter.
There is still a lot of nervousness.
The dollar's a challenge. In addition to this surge in real rates,
dislocation between some of the central banks.
There could be further downside risk.
Volatility is about 10-15% higher than it was a few months ago.
This is a hard market.
Getting those earnings expectations down is something that we really need to see.
Investors will get to hear from CEOs.
Investors want to hear management speak.
What kind of impact this environment has on their business.
See some companies rip off the earnings Band-Aid.
And really kind of throw in more of a towel.
We're bracing for some pre-announcements and earnings cuts.
The mood right now is one of extreme caution.
Number one is earnings. Number two is PMIs. We haven't seen that contraction yet. And number three is jobs.
Joining us now to discuss is TD's Priya Misra Academy's Peter Cheer. Priya, fantastic to catch up with you. First question goes to you. Jim Bianco of Bianco Research said last week was about high volatility, poor liquidity and financial stress. How much stress is there out there right now?
I think there is stress. I mean, you look at any measure of stress, be it volatility, realized, implied, you look at risk assets. I think, what we're dealing with is a global economy that's headed into a recession. And the central bank community is saying, we're focused on inflation. That's public enemy number one. And so their ability to respond is just much lower. So I would say there is stress as people are figuring out how to deal with volatility. What's a good hedge? I would say cash is the only asset that has sort of made sense. Not that you're earning any positive real rates there. That's what's creating the stress. But, I don't think, and it's a tough way to start a Monday, but I don't think that stress goes away because the US data is still strong. I mean, I think globally data has started to turn, but as the US data starts to slow down, I think that stress remains because we just wait for central banks to respond and we don't get that response. So, I think we just have to get used to high volatility, high levels of financial stress and keep liquidity levels high.
Pete, to what extent are markets cracking here over the last few weeks?
It's become a little bit nervous what's going on in large bond markets. You saw the gilt market kind of become an utter disaster. It's trading all over the place. And I think there's some fear, increasingly maybe realistic, that breaks into other markets. We saw really weak auctions last week. Treasury market liquidity's been nothing short of awful. So I think that's something we've got to watch very, very closely. If this continues to leak, we can have real problems because the other markets just cannot withstand this level of treasury market volatility.
Pete, it was the gilt market that really got everyone's attention. For me, it was how the market responded. That was far more interesting than what we got announced the week before. It was how the market responded to it. And the response that I got, Pete, was that the UK market was unique. And it is. The pension fund, the pension industry dominates that market, shapes it to a large extent. Do you think what we saw in the UK can spill over? We can see more of that in Europe, in the United States, in treasuries, in bunds and elsewhere?
I do think so. I think we've got to be very cautious. We've got quantitative tightening going on. And to me, I've always believed that quantitative tightening and easing is nothing like rate hikes. It goes directly to asset prices. So we have money coming out of the system right now. And just look at our own market. We've had this 20-year treasury trading at some awkward yield that sticks out like a sore thumb, right? The biggest economy in the world, the biggest bond market in the world should not have such weird kinks in the curve. We've had that. We've put up with that. So, yeah, I think we are a little bit more fraught for danger unless we get this under control.
Priya, when does the long bond start behaving like a long bond that's going into a recession?
So I think there's some of that getting priced in. It's really hard because the US data is strong for the market to price in that many cuts. And you've got a Fed that's saying, look at the 1970s, we're not going to respond quickly, which is why I think that long bond is struggling to rally more. You start to see weak data and perhaps it's weak earnings guidance. I think that's when the long bond moves. I mean, I would draw a distinction between the US market or the US Treasury market and the gilt market, which is dominated by LDI. I think in the US, this long bond is going to become the risk asset hedge, once data or earnings guidance starts to go down. So right now we're barely pricing in rate cuts, 100 basis points of cuts. In our view, this is going to be a recession next year, a longer recession than what most people think, a deeper recession than most people think. So I think at that point, the long bond will start to price in cuts, at least to neutral, if not below. I would argue the Fed will need to get into accommodative territory in 2024, 25. But the long bond is a 30-year view. I think those rates will decline, but we really need to see the data crack. And so far, the U.S. economy is still on fire.
Peter Scheer, another way of asking this is, can we break the positive correlation between equities, risk assets, and the Treasury market?
So I think briefly we can. Ultimately, I don't think we see the lows in equity until we see a really big risk-off move. Once people really start pricing in recession, I'm with Priya on that. I think we are going to get a recession. I think it's going to be deeper and it's going to come sooner even than she's talking about. And I do argue one thing. I think the economic data is turning over faster than we realize. Some of the old data, so August data, doesn't look as bad. You start looking at stuff that's more contemporaneous, it's looking weak. Housing's looking weak. Autos, used auto sales, those are looking weak. Everyone I talk to in the retail industry is very unclear what the holiday season is going to look like, and more importantly, what orders are going to look like for February. So I think we've got an overhang build, and I think we're pointing to a lot of weak data that's already there, but you kind of have to look at the right thing. So I think recession sooner, deeper, and we end this whole equity downside with a big risk-off move. But in the meantime, I think we could get one relief rally.
We'll keep building on that. Futures right now positive by about 1% on the S&P to kick off Q4. Payroll's coming up later this week. Mike McKee's going to be on top of that for you. Morning, Mike.
Good morning, John. I think the one thing I have learned is never leave a British guy in charge of global sovereigns while I go on vacation, because the questions become over the last 5 days, are things starting to break? Or as even Peter Scheer says, are they just starting to break, slow down, as the Fed expects it to? This week, we'll find out a lot more about where we're going with that. The Fed raising rates, the economy is supposed to slow, but how fast and how far? The latest on manufacturing later today at 10 a.m. with ISM. It's been strong, but the real question is, what about prices? Are they starting to slow? Tomorrow, more on factories, but the number of the day is job openings and labor turnover jolts, because the Fed's made a big deal out of the number of job openings. They say that's a sign the labor market is still too tight. So is that still true? More on jobs Wednesday with ADP. Totally revamped, of course, the new model, no track record, so we're not sure what's going to tell us, but people trade on it. And then on Thursday, we get the jobless claims numbers. Friday, the big number of the week, September jobs. Hiring is forecast to slow, but here's the question: how much? And how much is it going to take for the Fed to change its mind on how much it needs to raise interest rates in November? A lot of people think this report really won't change their mind, but if it does slow significantly, or we see a jump in unemployment, maybe the Fed has license to not do 75. We'll have a pretty good idea of what they're thinking by the end of the week, John, because 9 of the 19 policymakers are speaking this week, including New York Fed President John Williams, who usually gives a pretty good signal as to where Jay Powell is going with things. We'll also hear from new governors, Philip Jefferson and Lisa Cook. So a lot for people to digest this week.
Mike McKee, Mankiw and Krugman almost agreeing that the Fed risks taking this too far. What did you make of that?
Yeah, I think what we're seeing now is the idea that the Fed and other central banks don't know how far they can go. And we're starting to get signs from the markets that they may be going a little bit too far. We'll see if things calm down in markets, and if they keep getting slower in the economy, then maybe the Fed will have to change its views.
Mike McKee, thank you, sir. Priya, the line that stuck out for all of us when it came to the Fed speak, and you can pick up on the nuance, the differences between everyone, but Vice Chair Brainerd, when she says we are committed to not pulling back prematurely, is that one of the most important lines that comes out of the Fed speak at the moment? They're committed almost to being late.
I think so. I think they're telling us that they are going to be focused on inflation. And, until inflation gets down to 2%, they're not going to ease up. The other thing it tells us is things can slow down, but it's what the pain that they've talked about, that there will be pain in this adjustment process. This is collateral damage. So I took that to be very bearish for risk assets, and actually telling me that the curve can keep inverting even the first sign of slowing in growth, the Fed is not going to respond. And so I think the problem is the ghost of the 1970s is, I think, going to constrain the Fed. I already think that they should be looking at lags in the data. Forget looking at lags in inflation, which will take a while to come down. They're almost telling us that they will not be responding to weakness in economic growth. And therefore, they're going to be late. So I think they're going to have to cut a lot more, because if you start late, you have to go a lot more, which is why I think the market's underpricing the extent of cuts in 2024. But they might even start to cut in 24, as opposed to we're looking for them to start to ease in end of 23. But if they're so worried about the 1970s mistake being repeated, I think they're just going to let the pain build until they're absolutely sure that inflation expectations have been anchored. But you look at the market, I would say, and inflation expectations are well anchored. The Fed can take some comfort in that. But I think it's the 70s. It's all the research on the 70s that's going to make them late this time around in responding to slowdown.
And following the labour market, being emboldened by it, Pete, can you talk to me about the risk of being emboldened by a lagging indicator with claims south of 200K, just keeping the light green, bright green for them to keep on hiking?
One, we'll get a lot more clarity this week because there's been a big divergence between the household and the establishment survey on non-farm payroll. So we'll see some of that, whether that clears up at all. Again, I think on the Fed, they've been talking a very tough game since Jackson Hole. They're clearly on point. They did everything together. But I think it's relatively easy to say you're not going to shoot till they see the whites of their eyes to then actually do this. So I think if the data starts turning over any weakness, they're going to have a lot of second thoughts, because as much as they don't want inflation, job losses and recession, especially coming into election, are awful. So I think they are talking very tough. They're sticking to a script, but how strong they'll be if that data rolls over, I don't know about that.
Pete, one line that sticks out to me, it's been used by a few people over the last week: you can't fire what you can't hire. Pete, it's been a massive struggle to attract talent. And I just wonder how badly earnings are going to look, how bad earnings will look before we even start to see any deterioration in the labour market, given that so many of these companies couldn't hire what they were looking for.
Yeah, so what I'm looking for is a deterioration in these service providers. So I think companies are going to be very reluctant to fire their own people, because, like you say, it was so hard to get people. They're going to keep what they have. But I think you'll start looking at cutting, whether they kind of cut on their accounting costs, web services, stuff like that. So I think you're going to have to look there to see the first signs that mainstream economy is really hurting.
Peter Cheer sticking with us alongside Priya Misra. Whole host of people cutting price targets this morning. Citi, Credit Suisse. Jonathan Golub said this over at Credit Suisse on the S&P 500. We're lowering our 22 price target to 38.50 from 4300, initiating our 23 target of 40.50. This implies 7.4% upside through the end of 22, 5.2% through next year. So they're cutting the price targets, though I have to say Golub over at Credit Suisse is still standing pretty bullish. We'll pick up on that story a little bit later. Equity futures right now positive 1% on the S&P, about 20 or so minutes away from the opening bout. Up next, Credit Suisse stoking financial stability concerns.
Clearly, I mean, the stuff that we're seeing now with, these banks, CDS, Credit Suisse, etc., people are just worried about potential financial stability risks.
That conversation up next.
As central banks embark on inflation fighting at all costs with raising rates and potentially withdrawing liquidity, something can break. Where we are at this juncture is different from the Lehman moment, is different from the global financial crisis in that we don't have balance sheet recession. We have a recession likely engineered by central bank tightening in order to fight inflation. Our expectation for default is more contained versus what's actually in the price.
Shares of Credit Suisse hitting an all-time low. The cost of insuring the bank's debt against default reaching a record high. The CEO writing in a memo Friday, this is a critical moment for the whole organisation. No doubt there will be more noise in the markets and the press. I trust that you are not confusing our day-to-day stock price performance with the strong capital base and liquidity position of the bank. Shonali Basak is going to be on top of this story for us, our Wall Street correspondent. Shonali, good morning.
Good morning, John. Thank you very much. You know, you have the CEO of Credit Suisse, his senior executive, speaking to employees, to investors, to clients throughout the weekend as you see their credit default swaps spread out. However, remember, we have to do this with a big tone of a reality here. These are still very far from distressed levels, and they are not what we've seen with banks in the last decade or so. We have Boaz Weinstein of Saba Capital really tweeting online saying that this feels like a lot of scaremongering. This is not as wide as we've seen even Morgan Stanley in 2011 and 2012. Another interesting comparison to make is more recent with Deutsche Bank in 2016. Remember, Credit Suisse's capital ratios now are higher than even when Deutsche Bank was at that time. Yet, again, as we've been talking about, the credit default swaps have just widened out so much. At that time, remember, Deutsche Bank was facing a multi-billion-dollar fine. Now, Credit Suisse, as we know, does not have one massive event like that coming up. However, we know that regulators would look at this and be worried. They'd be worried for a couple of reasons here. Those reasons include that Credit Suisse is facing here a very vicious cycle of rising funding costs as well as a declining stock price. So the cost of funding is going up for the bank while revenues are also under pressure and there is concern among investors. But the longer term here is what you have to keep an eye on. How does Credit Suisse make it through this market? These challenges in the near term with its stock price just makes that turnaround even harder. And like the CEO has told his employees just this weekend, as the stock is falling like a thud, what he told them was he's looking to rise like a phoenix from the ashes. So they are focused on that turnaround plan for the end of October. Can they hold their stock up until then?
Good luck to them, Shonali, because we all know some fantastic people who work at that bank. 2008. We always have to have the 2008 conversation. Let's just park the 2008 story and just focus on this bank. They're going to come out with a strategic review at the end of this month. The new strategy, whatever it is, Shonali, most people assume that they're going to have to raise capital. Tell us how much they might have to raise capital by based on the reporting that you've seen and how difficult that will be with the stock traded with a 3 handle.
Probably one of the more prominent notes around this is their KBW's estimate around $4 billion, 4 billion euros or so. Listen, the problem here is that raising money, if they have to issue shares at this point, to your point, with the stock declining that much, it would be highly dilutive for long-term holders. And they could also sell some assets, but it wouldn't get you to that $4 billion mark. So there is a lot of money that could be needed for this turnaround plan, which again, this turnaround plan before we were talking about the issues on its stock and otherwise, which have now been down more than 60% this year, we were still looking at a multi-year turnaround. So how do these issues that we're facing today for Credit Suisse compound that issue even further as they look through a turnaround through a tough economic cycle as well? 2008, John, you know this, the regulators really have to be watching this with a lot of bated breath, even with those capital ratios being in the targeted range here.
Big time. Shonali, thank you. Shonali Basak on top of the story for us. She'll do that for us all week, no doubt. I want to come to you on this, Peter Chair. Pete, can you tell me how useful the CDS market actually is to gauge risk like this conversation we're having right now? What do you make of it?
So I agree with what Boaz said. I think this was a little bit overdone. One, the CDS market tends to overshoot, right? It's fairly illiquid. Then there's a couple other factors that are really impacting the CDS market right now. One, overall, bond prices are below par. So there are these technical factors when bond prices get below par, and they're well below par across the globe, not because of credit risk, but because of overall yields. So that impacts the pricing of CDS spreads. You've had a liquid bond market, so if people need something done, they'll go to the CDS market, which does tend to be a little bit more liquid in times of stress. So I think it's a little bit overshot, and you can only take so much out about this. And then when people start converting CDS spreads to default probabilities, there's a lot of noise in that. One, not every reason you're getting paid a basis point of spread is because of credit risk. There's all sorts of liquidity risk, all sorts of other reasons to get paid that. You have to look at recoveries. And finally, especially when it comes to banks, the regulators learned one thing through 2007 and 2008. Do not let this get to a fear point in senior credit. And it's not at that point. I don't see any way they will get to doing that. Separate from what they're trying to do on inflation fighting, they all know you cannot let this creep into the banking system. So I would not be too worried about what's going on in CS on the bond side at this point.
Pete, just to pick up on that then, are you saying on the bond side that's the better way of measuring the amount of stress that might be out there in a single name?
I think you have to take a look at all of them, but yes, you want to look at that. You want to look at where the sub-debt is. So there is some stress. I think it's overdone. I think it winds up coming back tighter in the coming days and weeks.
Misra, can you tell me just how you're gauging how things are developing in Europe?
Sure. Well, I mean, in Europe, you mean UK or Europe?
I mean,
Because
Europe
think UK is
specifically,
what's driving.
financial instability. You're starting to see
Right.
Italian spreads blow back out over the last couple of weeks. There's a worry the ECB might have to step in there. I think that's the theme of the last week. We spent the last year talking about central banks attacking inflation. Now the concern much more so on financial instability, whether it's the gilt market or Credit Suisse.
Absolutely. And I think it may seem at odds. If the ECB is going to keep moving the rates higher, it's going to be hard for them to prevent that widening in Italian spreads. I mean, they've got that policy in, they might engage, but in our view, it's a little, I mean, they're fighting one problem on one hand, and then they create financial stability issues on the other hand. I mean, it's a tough balance, but I think at some point they're going to have to let these spreads widen. And at some point it brings capital in. I think we have to all get used to cost of capital across the board is rising. It'll be higher for Italy than it would be for Bunds. There's only so much the ECB can push back against that. And I think that's going to hasten the slowdown in Europe, where financial conditions tighten a lot. The ECB is unable to, I think, get those Italian spreads much tighter. I think they can just slow down. It's what the BOJ is doing. There is a common theme here that they're all trying to tighten financial conditions, but at a slower pace. But they're fighting, I think all they can do is try and slow down the process as opposed to really fight it. So we're actually negative on Italian spreads, on Spanish spreads, because we think the ECB is going to have to continue to hike given their very high inflation prints here.
Priya, just finally, I've asked this question 20 different ways over the last week. If these central banks have to choose between recession and financial instability or higher inflation for longer, what do you think they choose?
I think they're going to have, I think financial stability is something they will push back against. I mean, at least slow down the volatility, prevent this from, because and it becomes a VAR shock, you get all sorts of correlation breakdown, etc. So I think that they're going to try and push back against too much financial instability. I think they're going to risk a recession. I mean, 6 months ago, I would have told you that they'll take a higher inflation route. But increasingly, I'm getting the sense that they're so terrified of an inflation problem that they will risk a recession just to get inflation, maybe not down to 2%, the 3%, maybe that's the new 2%. But I think the levels are just too high for them to tolerate high levels of inflation just to keep growth going.
I've heard that from a few places now, that eventually they're just going to have to accept 3. Priya Misra, Peter Cheer, to the two of you, thank you for kicking off Q4 with us. Futures right now positive 1%. Coming up the morning calls and later, picked heads. Luca Paolini expected the S&P 500 to head towards 3K. Luca joining us around the opening bout from New York. This is Bloomberg. Five minutes away from the opening bell, equity futures with a decent pop here. Will it stick? Up 1% on the S&P, up 6 or 0.7% on the Nasdaq. That's the price action. Here are your morning calls. First up, Morgan Stanley upgrading bulks to overweight, $34 price target, highlighting the company's solid macro positioning and more favourable backdrop. Your second call from Goldman, upgrading Wells Fargo to buy while downgrading Citi to neutral, expecting the two banks to perform much differently in a recessionary environment. And finally, Argus downgrading Nike to a hold, warning that high inventory levels could pose a threat to upcoming earnings. That stock is down just a little bit by 0.1%. Up next, investors gearing up for a critical earnings season. Luca Paolini warning recession is inevitable, expecting the S&P 500 to head towards 3K. That's next, the opening bout just around the corner. Live from New York City this morning. Good morning to you all. Counting you down to the opening bell, about 20 seconds away. September absolutely brutal. Down and down hard on the month, on the quarter, for a third consecutive quarter on the S&P 500. The longest stretch of losses, quarterly losses, going all the way back to 2009. Let's the opening bell, switch to the board and get to the bond market. Yield shaping up as follows on a 10-year, down 15 basis points on a 10-year yield to 367.84. Euro showing a little bit of weakness. Euro dollar negative 1/3% at 97.74. And crude exploding higher on speculation that OPEC Plus might be about to deliver cuts. We're up 6% on WTI, $84 and around about 20 cents. That's the cross-asset price action. Let's get you some movers. Here's Katie.
John, we have Tesla dropping from the bell, and Ed Ludlow is going to have more in just a minute. But just know that while actual deliveries were at a record, we're talking about 345,000 cars. That number still fell short of estimates. You have Tesla lower by about 4%, down more than 12% over the past 2 weeks. Moving on, we have Peloton, just a little bit higher after signing a deal with Hilton to put bikes in over 5,000 U.S. hotels. This is the first chain to offer Peloton bikes across all of its branded U.S. hotels. It's needed good news for Peloton, but just a drop in the bucket. The shares are still down about 90% over the last year. And moving on, like you said, it's shaping up to be a big day for oil. That's after weekend news that OPEC Plus considering an output cut of more than 1 million barrels per day. That's boosting lights of Exxon and Halliburton. This morning, you have crude about 6% higher at the moment.
Katie, thank you. What a pop for energy. And for the energy names on the S&P 500, about a minute and 20 seconds into this, the S&P up by 1%. Energy names up by more than 2% this morning. Stocks rebounding just a bit after recording their biggest monthly decline in more than 2 years. Investors gearing up for a critical earnings season.
We are starting to see some companies rip off the earnings Band-Aid.
We're bracing for some pre-announcements and earnings cuts.
Headwinds are beginning to intensify.
Getting those earnings expectations down is something that we really need to see.
The growth outlook remains dire.
There could be further downside risks.
Starting to show some cracks in the foundation.
The equity market probably has further to go down.
There is still a lot of nervousness.
The mood right now is one of extreme caution.
There's still room, people believe, for more downside.
For more, let's catch up with Danny Berger. Hey, Danny.
Hey, John, it's really going to be the question that we ask all this earnings season. Is the worst of it priced in? If you look at just a headline basis for earnings per share, it's hard to argue that it is priced in. Again, that estimate going forward through next year, every quarter shows a gain in earnings. Now, if you expect a recession next year, this is certainly not an earnings recession. Matt Maley over at Miller Tabak points out that every recession since World War II has seen a decline in earnings. That is not what's priced in. Now, to be sure, at a bottom-up level, we are seeing those revisions drop. We have net downside revisions more so than upgrades for the 17th consecutive week. It's not surprising considering we've heard everyone from Micron to Nike to CarMax, all of them warning on their earnings. But even this picture, John, we still got to ask, is this the worst of it considering that margins are under pressure with high prices and a Fed that is intent on continuing to tighten conditions? Easy money for these companies is certainly over.
The corporate guidance, the numbers, the earnings, the sales, the deliveries, not great at the moment. Danny Berger, thank you. Tesla front and center on that front. We're down by almost 6% on Tesla in early trading. Shares of Tesla under pressure after Q3 deliveries fell short of estimates. The company running the following. As our production volumes continue to grow, it's becoming increasingly challenging to secure vehicle transportation capacity and at a reasonable cost during these peak logistics weeks. On top of this, we're lucky to have Ed Ludlow with us. Morning, Ed.
Yeah, good morning, John. Frankly, this was another record-breaking quarter for Tesla in terms of deliveries. 4 factories on 3 continents firing on all cylinders. But ultimately, that delivery number of 343,830 vehicles was considerably below consensus. Now we see the stock down 6.4%, biggest drag on the NASDAQ 100. Basically, a transition to a more even regional mix of production across those factories meant that more vehicles were in transit at the end of the quarter. Elon Musk took to Twitter, you won't be surprised to hear, to explain that they were fighting increased expediting costs at the end of that quarter. And going forward, they hope there will be a smoother and more even distribution intra-quarter in terms of those delivers. Some on the street and indeed the big Tesla fans took to Twitter over the weekend to kind of front run this stock drop, right, and say the naysayers are going to say that this is about demand. Well, the sell side seems to believe Tesla's explanation that this is an issue of logistics. One other data point I point to is the percentage of vehicles produced that were delivered, around 94%. That is very low relative to the prior 15 quarters, which does give some further evidence that this is not a demand issue. Simply, the cars were ordered, they just weren't delivered to customers. So we looked to that December quarter data to find out what the true effect of global rising rates is and inflation on the consumer, John.
Ed, are you surprised we're still grappling with these issues right now, going into 2023?
No, not particularly, partly because this commentary has been consistent, right? I'm thinking about what I'm hearing across some of those pre-announcements in earnings. I spoke to Amazon's SVP of devices, Dave Limp, last week, and he said actually the components picture is improving, various semiconductors, parts for electronics. The issue that is lingering is moving things from A to B. He talks about ocean freight, for example, having basically unpalatably high costs. Well, this is what Tesla's saying as well, that there's always a sprint finish at the end of the quarter for Tesla. What they seem to be doing is saying, we're not prepared to pay what our carriers are asking us to pay. We need to fix this longer term. And you wonder how much that is an inflationary factor, right? I remember talking to you from the Port of LA, you know, a year ago, thinking, what's the read-through here from these freight costs through to inflation? Well, as we zero in, the freight costs are still high, John, is what I'm trying to say.
I can't believe that's already been a year. Ed, thank you. Ed Ludlow on a story for us all day on TV and on radio. Tesla down about 6%, the biggest one-day drop going back a week. Their stock has been all over the place. We're down for 3 straight sessions on Tesla. Pictet's Luca Paolini expecting the S&P 500 to head towards 3,000. Says the following: global recession is inevitable. Inflation is always and everywhere a problem. US investors should diversify away from US stocks, start reallocating strategically into government bonds, especially in the US, as nominal GDP growth has peaked. Luca, awesome to catch up. Some big calls here. Let's start with the bond one. You're calling a peak in government bond yields. Why?
Yes, morning, Jonathan. I think the main reason, look, is that inflation has peaked in the US, growth is weaker, and I think the Federal Reserve is coming to the end, or quickly, I think, to this kind of monetary tightening. So I think you put everything together. The sentiment is very bearish on bonds. I think all the conditions are there for a peak in bond yield, especially in the US. I think much less so in the rest of the world, especially in Europe.
Luca, specifically in the US, is that right the way through the curve, 2s out to 10s, or is it a particular part of the curve where you have a little bit more conviction on?
Look, we think that bond yields have peaked. I think the 2 years are probably peaking right now as well. So no, I think it's a general kind of decline in bond yields that we see across the curve. And I have to say that we need to see a steeper yield curve to get more optimistic about the markets in general.
Luca, the 10-year, the peak in that, is that dependent on what this Fed does or does not do? Or is this just a world where you think this bond market, particularly the long bond, starts behaving like a long bond typically does, going into a recession?
Well, look, I think the situation, is pretty clear. You have a peak in nominal GDP growth, and bond yields always follow that. I think the question is if the Fed is going to tighten much more than they should. I think the jury is still out on this. But I do believe that the Fed will look at the growth numbers, and I think you're going to hike a couple of times more, but markets always anticipate the next move. And the next move, I think, is going to be for the Fed to sound a little bit less hawkish, and this should really give a lot of, a boost to bond markets in general.
And Mike Wilson of Morgan Stanley talked about what that might mean for the equity market. This is what he had to say. The moment the Fed decides to put out the fire, stocks and other risk assets are likely to rally sharply. Trying to play that for more than a tradable bounce is a bad idea, in our view, because we still have to deal with the oncoming earnings recession. How bad do you think these earnings are going to be, Luca? And do you think what's happened with FedEx, what's happened with Nike, the reports on Apple, are a decent indicator of what you can expect through the next few months?
Well, look, I think, as always, earnings will probably surprise on the upside. But the reality is that we need to look at the guidance. And I think what I want to see is what companies are planning to do, especially in terms of investment plans. We tend to focus a lot on consumers. Are the consumers spending, yes or no? I think we have really to look at what their plans are in terms of investment. And that I'm really worried because earnings are falling. I think obviously confidence is down, and it's difficult to see any reason why there should be an expansion in investment spending. And if there is no expansion in investment spending, you have a recession. And I think so there is more downside on earnings in the coming quarters. But I have to say that what I'm going to look at is the guidance, not so much at the earnings per share, which I think they're going to be very weak, but they're not going to drive markets down.
Luca, in your latest note, you wrote down the preconditions for adding to equity exposure. Could you share that with us? What are the preconditions, the list of things you're waiting for to add to equity exposure?
Well, the first is to have earnings kind of expectation, at least in line with trend. If you look at the US, we are still 15% above trend, and we are just pretty much entering a recession. That's clearly not sustainable. The second thing that I want to look is a peak in short-term interest rates or a steeper yield curve. And then ideally, I would like to see more attractive valuation, which is not necessarily what you want to have because it means that the market should fall a little bit more. But definitely a steeper yield curve and a trough also in earning revisions as well. And we have seen a lot of negative news on revisions. So I think this is the preconditions that I want to see before turning more optimistic on stocks.
Luca, we went through that opening quote of yours and we picked out the peak in nominal GDP, picked out the move into government bonds. Let's pick out that final piece of it. The US investors should diversify away from US stocks. Luca, to where and why away from the US?
Look, John, it's not going to be easy. When we have a global recession and markets down, there are not many places where you can hide. I think I can mention one, though, Japan. Japan, you have an economy that is actually growing, interesting enough. There is no risk of inflation. Monetary policy is supportive, and you still have decent valuation, and obviously the cheap currency as well. So if I have to mention one now, probably the Japanese equity market is the most attractive for US investors.
Luca, are you comfortable with that over a long time horizon? What is the time horizon for that investment?
We're talking about 6 months to 12 months. I think if you go over that, I think the attraction, I think, of the U.S. market is probably more significant. But over the next 6 to 12 months, I think for the U.S. it's going to be difficult. It's going to be difficult for Europe, and if you look at Asia, especially Japan.
Luca Paolini of Pictet. Luca, fantastic to catch up, sir. As always, the S&P 500 up by around about 0.6%. Talked about this energy move in the commodity market rallying off the back of this story around OPEC+. Energy names on the S&P right now up 3.98%, up almost 4%. That's a big story for us this morning. Coming up, Europe's energy crisis continuing to escalate.
We're at a very challenging moment, no? Because the war is entering a new phase, or so it seems. We also see that Nord Stream supply was cut 1st of September.
We'll get the latest on Europe and the latest on OPEC+ and a conversation about output cuts next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Bob Dole, Crossmark Global Investments CIO. That conversation at 3:30 p.m. in New York, 8:30 p.m. in London. This is Bloomberg.
We're at a very challenging moment, no? Because the war is entering a new phase, or so it seems. We also see that Nord Stream supply was cut 1st of September. The positive element here is that prices are not continuing to escalate as they did in past months when Putin was using the energy blackmail.
Brilliant conversation there with Spain's Deputy Prime Minister Nadia Calvino speaking to Bloomberg's Maria Tadeo. Getting some breaking news here stateside. Let's get to it. Here's Mike McKee.
Well, John, the Fed is trying to slow growth, but the first indicator of the month of October suggests there's still strength in manufacturing. The S&P Global PMI for manufacturing in the U.S. is at 52. That's up from 51.8 the prior month. The forecast was for no change, so a little bit stronger on the manufacturing side than we had anticipated. ISM manufacturing comes out at 10 o'clock, top of the hour, and that is also expected to register 52, which would be a decline in that index. We'll see. The world is struggling right now with manufacturing outside of the United States. We're pretty much the only country showing expansion. You look at the global slowdown in Europe today, all of the countries reporting in the 40s. Italy had a slight rise, but still below the 50 mark. And so we're looking at numbers that are just telling us recession is pretty much here on the European manufacturing side.
Mike McKee, what do you learn from the regional Fed indicators at the same time?
Well, the regional Feds have been telling different stories depending on what region you're in, but they have all kind of at least regrouped, I guess was the way you'd put it. They're not all falling anymore. They're not rising hugely, but it does show there's still some strength in manufacturing in these regional indexes, and it suggests that the Fed's work is not done on that side. We've been expecting manufacturing to slow in favor of services, but so far, manufacturing hangs in.
Mike McKee, thank you. Looking forward to the breakdown of the data in around about 13 minutes' time. Mike McKee and the team breaking down ISM in around about 13 minutes. Looking forward to that. Yields much lower this morning. We're down 15 basis points on a 10-year to 368. At the front end on twos, we're down about 15 basis points to 4.126%. In the equity market, a rally up by more than 1%. Leading the way, energy stocks up by 4.6. Energy in the commodity market rallying hard. OPEC Plus considering an output cut by more than 1 million barrels, the first of that size in more than 2 years. Energy Aspects and Rita Sen saying the following: OPEC Plus are very focused on stronger US interest rates and its impact on emerging market demand. Hence, they want to preempt any possible surpluses in the global market. Team coverage starts right now with Bloomberg's Maria Tadeo in Luxembourg alongside Will Kennedy in London. Will, first to you. Were you and the team surprised by this one from OPEC Plus and the team?
I think we were surprised that they suddenly switched it to an in-person meeting, which suggests that they're going to take significant policy action. And of course, a cut by 1 million barrels a day or more would be a significant policy action. But I think OPEC has been headed in this direction for a little while. They are clearly, as Van Meter said, concerned about the slowdown in the economy. They're concerned about the weakness in China's economy. And they felt that they needed to act and act soon before the market got away from them. So to an extent, but I think that the momentum to some sort of cut has been building.
Well, we're having the bets waged right now, whether this one goes on for 12 or 13 minutes or longer or shorter in person in Vienna. Is this going to be a long meeting?
I think it will be longer than the 12 to 13 minute meetings that we've been used to because, you know, they've all travelled a long way to get there apart from anything else. But clearly it's an important moment in OPEC that they're getting back together in person after 2 years. I think that a lot of ministers are keen to do that, to reconnect with their colleagues, to sit down and have one-to-one bilaterals. They haven't done this for more than 2 years. So I think we can expect a slightly longer meeting. And if they are going to discuss things other than production levels, perhaps they're going to discuss how the agreement works into next year, what people's baseline quotas are, that kind of thing, then yes, it may take a little longer. We'll see.
It's probably not what energy ministers across Europe would like to hear. Maria Tadeo, what's the latest where you are?
Listen, they have to deal with a lot here. They have to deal with an escalation in the actual war in Ukraine. They have to deal with the energy war, double-digit inflation, and of course calls now for a recession. So it is a lot. And then on top of that, Jonathan, and I really want to stress is a number of countries also taken aback by the mega package that was announced last week by Germany, 200 billion euros. Of course, there is, to put it diplomatically, some questions around whether or not this is a problem for the level playing field in Europe. Remember, not everyone has the fiscal capacity to deal with a crisis of this magnitude that Germany has. And to me, what this says, and this is a takeaway that I take from this, is that the countries that are pushing for this price cap on gas will now double down on this, saying, okay, you do your 200 billion euros, but then we need to cap gas prices. It's the only way everyone gets a fair deal. So this story is far from dead.
Maria, just pick up on something you said. How united are the Europeans still on this issue?
Look, the statement du jour here is that you need to stay united and show solidarity. And so far, the European Union, as you know, has approved every sanctions package unanimously. It's the only way this can get done. But there are a number of countries that behind the scenes here will tell you they were taken aback by the lack of communication from Germany. The fact that they announced a huge package, 200 billion euros, that is very difficult to match for another number of countries. And they now want to show or see from Berlin what is the political direction in the next few months. So there is a lot of pressure on the Germans to not change course, but explain themselves.
Maria Tadeo, Will Kennedy, to the two of you, thank you. Appreciate your time, as always, on the commodity market and beyond. Brent crude up by 4.93% on Brent to 89.40. On WTI up by almost 6% this morning, up by 5.9% to 84.17. So we get you some sector price action. Let's do that with Katie Greifeld. Hey, Katie.
Hey, John. Well, if you look at the sector level, you're looking at a big, broad rally. I see about 10 of 11 sectors higher today, with energy leading the way. That's, of course, in anticipation of that potential OPEC plus cut. Consumer discretionary is your sole laggard, as you can see there. That is mostly Tesla's fault. That's the biggest percent and points loser in that sector. And if we focus on autos and on oil specifically, of course, Tesla miss on those delivery forecasts. It's dragging down the likes of Rivian. It's dragging down the likes of Lucid. That is bringing down an index of U.S. automobile makers. Though you did have the likes of GM turning positive. Oil, meanwhile, while America's oil and gas, it's the U.S. shale producers that are actually up a bit more than the larger multinational rivals on that potential cut. But all oil today really just screaming higher, John.
Crude getting a nice rally. Katie, thank you. Up by 5.8% on WTI, up by 4.9% on Brent. Energy equities up by 4.2% on the S&P 500. On the S&P on a benchmark, we travel higher, pushing higher by a little more than 1 full percentage point. Up next on the program, the trading diary from New York City. This is Bloomberg. Equities rallying this morning, 25 minutes in. Good morning to you. State of play looks like this on the S&P, advancing by 1 full percentage point. On the Nasdaq 100, up by 0.7%. Within the S&P, the sector breakdown of the rally this morning, leading the way, the energy names off the back of the rally in the commodity market, with crude popping higher off the back of a conversation about OPEC plus cuts to output, supporting crude, supporting the energy stocks this morning too. Yields are lower, I would say aggressively so. 2s, 10s and 30s. This market's all over the place. We're down 14 basis points on a 2-year. Your yield there 413.82 on a 10-year. Down about 12 basis points to 370. Through 4% last week briefly. And I think we closed last week for another weekly gain in yields for a 9th consecutive week. Will we get some kind of sustainable retreat through this week so far? On a session, we're down by 12 basis points to 370. A little bit more economic data around the corner. That's the price action. Let's get to your trading diary. On that economic data, you'll get the ISM manufacturing numbers at the top of the hour. President Biden speaking at 2:45 this afternoon. Then a busy stretch of Fed speak. New York Fed President John Williams kicking things off at 3 p.m. Eastern. Mester and Daly headlining Tuesday, followed by Bostic on Wednesday. OPEC Plus meeting in Vienna on Wednesday. And finally, looking ahead to the main event, the US payrolls report coming up on Friday from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.